Today I want to talk about how the shorts are trying to hide their illegal AMC swaps in a last-ditch attempt to escape the squeeze before the coming crash. I want to break down how they're trying to hide these positions and what that means for their true short exposure. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Sloan tweeted saying, "Nice find, Reddit. This data is missing the 28th of January 2021. So let's first break down what we're actually looking at here, why the data on the 28th of January 2021 is hidden, and what that means for their true short exposure. Now this is actually an extract from the Archegos Credit Suisse lawsuit, and as a reminder it says that Archegos used security-based swaps to gain exposure to these securities while concealing the true size of the fund's positions from the market and our trading counterparties. Archegos used these swaps to gain a long or short position on an individual stock, and one employee said that I and others used this power to trade in such a way as to artificially manipulate the prices of those securities. He said, acting in the direction of the head of the fund, I traded to increase the price of names in which Archegos held long positions and reduce the price of securities in which the fund held shorts. Now this data shows Archegos' short exposure to a number of different securities on the 25th, 26th, 27th and 29th of January. Clearly it misses the 28th of January, but what I want to talk about more specifically is just how large some of these positions actually were and actually still are. Now on the 27th of January alone, Archegos held swaps with swap counterparty 1, 3, 5 and 6 for a total of $640 million, $420 million, $400 million and $36.8 million, around $1.5 billion worth of short swaps with Credit Suisse. Now if on the 27th of January, before the run up on the 28th, they held a total of $1.5 billion worth of notional exposure, I can only imagine how big this figure would have been on the 28th of January. Would it have been 3 billion, 6 billion, 10 billion, or maybe even more? And I think what's also important to remember is this is only Archegos' short exposure with Credit Suisse, not to mention their exposure with other major institutions, and not to mention the exposure of other hedge funds with all of these institutions as well. It's very likely that back on the 27th of January or the 28th of January, and still to this very day, there's likely hundreds of billions of dollars, if not trillions of dollars of short exposure in these meme stocks like AMC, GameStop, and many others. And part of the reason why I mention all of these stocks together, like AMC, GameStop, and many others like Bed Bath & Beyond, for example, is because this screenshot also proves our swap basket theory. On the 27th of January, Archegos held these swaps with swap counterparties 1, 3, 5, and 6, and what they are actually holding is custom basket swaps. That means Archegos is holding a swap short position on a complete basket of stocks, not just one specific stock like AMC, but an entire custom basket. And therefore Credit Suisse is likely still holding these custom basket swaps to this very day, and many other hedge funds out there are also holding these exact same custom basket swaps with many other major banks still to this very day. As I said, there's likely hundreds of billions of dollars, if not trillions of dollars of short exposure through these custom basket swaps on our meme stocks. And that is exactly why when one of these stocks squeezes, whether it's AMC, whether it's Ape, whether it's GameStop, or even one of the others, it will cause the short squeeze across the entire custom basket. But not only that, Archegos was also holding these custom basket swaps and ETF swaps as well. That means that Archegos was indeed shorting those ETFs. This one singular screenshot alone practically proves everything we've said about the shorts and how they've been shorting AMC and GameStop over the last 2 years. Not only have these hedge funds and market makers been shorting AMC through swaps, not only have they been shorting them through custom basket swaps, but they've also been shorting the ETFs as well. But it's also incredible how they're trying to hide their true notional exposure on the 28th of January, the day that AMC and GameStop ran up. We absolutely 100% knew these swaps were being used to short AMC and many other stocks. This singular screenshot proves it, and it proves they're still shorting them through these swaps to this very day and still trying to hide their positions. And if you haven't already, be sure to join the free Discord linked in the description below. We've got 1348 indicators and we talk about AMC and share due diligence all day long. And obviously, if you haven't yet signed up to Moomoo, be sure to sign up to Moomoo right now using the link in the description below. You can currently get a free $10 and 15 free shares on top of that, all worth up to $2,000 each, a grand total of up to $30,000. And I think somebody else that's also trying to hide his true position is Charles Gasparino. He said, I'm sure some naked shorting does exist, but the vast scandal that apes suggest should be placed in the same category as other conspiracy rubbish. And he said also, the whole dark pool thing is also a conspiracy theory. But it's interesting that what Charles Gasparino says on air completely contradicts his tweets. As Dade said, Charles tweets the whole dark pool thing is also a conspiracy theory. Yep, Charles is saying live on air that dark pools are highly unregulated.
You have these dark pools, and these dark pools are highly unregulated, and that's where the problem is here. We have 40 different trading venues. They're highly unregulated. There's some evidence that, you know, in terms of pricing, the owners of these dark pools, the people who run them, slow down the pricing data. Even if they buy the best pricing data available, they purposely slow it down, and that gives the high frequency traders a break. So what we're hearing now is that these dark pools, following Monday's turbulence and the last couple of days, particularly Monday, these dark pools. And these are the trading venues. This is not the New York Stock Exchange. If you trade a stock, you don't have to. It doesn't get traded on the New York Stock Exchange. It gets traded a lot of different places.
So even Charles Gasparino is saying there these dark pools are unregulated. Most of our trades go through these dark pools, and these market makers that operate these dark pools often slow down our trades and pass the trades through in the after hours. So how can he tweet one thing saying the dark pool thing is a conspiracy theory, but then also say that dark pools are unregulated and our orders are manipulated in these dark pools? And it seems the shorts and Charles Gasparino trying to hide their true short positions is all happening because some high-level international bankers have actually simulated the collapse of the global financial system. These international bankers have obviously performed this simulation, realised just how bad the market will crash, and that's why these shorts are trying to do absolutely everything they possibly can to escape the squeeze. It says a simulation of a theory-based catastrophe of global bankers collapsing the financial system was conducted fairly recently. It says the exercise aimed to replicate the reaction to a variety of theatrical large-scale cyber attacks on the world financial framework and ensuing bank runs and market disarray, largely driven by fake news. Clearly, these major institutions have realised when the economy does collapse, causing the squeeze, many of these major banks will be going under. And as Gordon Gekko tweeted, he said, at this point, I believe almost everything is tied to AMC, Ape and GameStop. He said most institutions and hedge funds and banks and all of the powers that be tried to short and destroy these stocks, and now they see how screwed they are. I've said previously in my videos that I originally thought the mother of all short squeezes would cause a number of hedge funds to collapse, but that all major banks would survive. But over the last year and a half, as we've all been crawling down this rabbit hole deeper and deeper, I'm now realising more and more every single day that not just one major bank will be going under, but potentially even 5 or 10, if not even more, major banks. And that's why Gordon says when we do squeeze, the theory of $100,000 per AMC share honestly wouldn't be a joke. Now again, I don't know if AMC will reach 100k per share. I do think it will reach 5k, 10k, maybe even higher, but at the same time I may be completely wrong and AMC may squeeze to well over $100,000. Especially as we continue crawling down this rabbit hole and we see just how hard these shorts are trying to hide their short positions and to attack all of these meme stocks. Another new development is Credit Suisse trying to cover up just how screwed they are by hiding tons and tons of comments. Credit Suisse recently tweeted saying, today we unveiled our new strategy and transformation plan, which are based on a series of decisive actions to create a simpler, more focused and more stable Credit Suisse. Obviously this tweet was met by a number of memes and also a number of separate comments and replies, and many of these replies have been hidden by the original tweet author, which is obviously Credit Suisse. For Credit Suisse to hide tons and tons of replies over and over again, it clearly shows just how screwed Credit Suisse actually is, and they're trying to stop their investors from figuring it out. And speaking of which, Ray Dalio is warning a painful credit crunch could tank financial markets and spark a recession, as a surge in government bond sales could cause private credit to dry up. Gold Telegraph also tweeted, obviously pointing out the fact that something is going to break. I think obviously a credit crunch would significantly add to the worries of the coming recession and the coming stock market crash and the coming property market crash as well. I think this credit crunch would exacerbate all of these existing problems and cause the stock market to crash further, cause property to crash even further as well, and cause a greater financial crisis. And speaking of which, you may have also heard the Fed decided today to again hike by another 75 basis points. However, there's actually a new sentence in this FOMC meeting that signals more increases down the line, but hints at possibly smaller increments. This suggests the Fed is going to slow down the hiking of interest rates, which is an interesting decision considering that inflation hasn't yet fallen. Inflation obviously hasn't yet reached this 2% target, but they're already talking about slowing down these interest rate hikes and potentially cutting them altogether. I think this really suggests to me the Fed is currently stuck and they don't really know what to do at the moment to bring down inflation but to not crash the financial system. It seems the Fed is stuck between a rock and a hard place and they're basically taking the option of doing nothing. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.